Can we go ahead and approve the agenda while we're waiting, Brian? Is that? Okay. Let's go ahead and approve the committee agenda, which is item 1. It's been moved.
I'll second.
Seconded. Any questions? All those in favor say aye.
Aye.
Opposed? Abstentions? Great. I think we'll skip over Chris's report until we get the public trickling in here. So let's go ahead and move to item 8, which is approval of the minutes from the February 3rd Investment Committee meeting, open session. Okay, been moved. Seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? Excellent.
Advisory is still meeting.
Okay, no problem. So Chris, we're gonna skip over your item 7, and let's see.
I am skipped.
I'm just trying to think of what we can tackle first. That would be. Is it all right if we jump into the general consultants reports? Is that okay with you, Alan? Is that no offense to, but I think some of the other items I think the public would appreciate hearing from, and not that they wouldn't appreciate hearing from you, Alan, but this is more routine. Let's just put it that way.
I don't take it personally.
So Alan.
Plus, for all intents and purposes, this is dated material anyway, and there have been updates since then, so this is totally great.
Okay.
This is a report ending the calendar year. I would urge you to go to INV 110. There's something I just want to point out that I think is important. There are 2 tables. One shows the performance versus the policy benchmark. The other is versus the median fund. Over all periods, with the exception of 10 years, you exceed the median, which for a fund your size is really something to take great pride in. But over all periods, you trail your benchmark, your custom policy benchmark. And in my opinion, that's an indicator that the policy benchmark might be a difficult, if not almost an impossible objective. And that's something that at some point I would urge you that we should take a look at. And I think that will come up a little bit later in the agenda. But the difference between that policy benchmark and a median fund is marked, and it's important for you to recognize that that's a very difficult objective.
Alan, can I jump in?
Sure.
Just to give you a data point on that, because I did a run of using an outside database of looking at all of our peers' benchmarks, not their return, but what were their benchmarks. And over the 3 and 5 year period, our benchmark isn't just in near the top, it is the top. It's actually the 100th or top 1 percentile. And what's amazing is it in the 3 and the 5 year period, it's 150 basis points even over the top 10th, the 90th percentile. So it's not like we're close. We're like way up at the extreme. So then we also ran it again. That was U.S. pension plans. So then we decided to run it against global peers, so multi-billion-dollar global peers. And again, quite to our surprise and discomfort, is the benchmark over 3 and 5 years, again, is in the 100th percentile, the highest ranked benchmark of anybody. So I agree with Alan. It's worth taking a look at. It is a darn challenge to beat. It's comprised of our asset allocation, so I think you should take some pride in the, the asset mix and the way it's structured. It's just hard to achieve it, but that's what obviously is helping drive the underlying performance of getting us there. So just a data point to put in your mind.
Okay, moving things along, if you would please go to INV 128. And this is a table that provides benchmark or index returns over periods up to 20 years. And as a long-term investor, in fact, 20 years is relevant. And what's really important to key in on is over 20 years, the S&P has had a return of a little over 8%, and the foreign markets have a return of less than 5. So this has been a period, a very lengthy period, where overweighting domestic equities versus international equities paid off. And in fact, you did that as a matter of policy, and you're slowly moving towards a more equal weighting, but you have been paid handsomely for having underweighted non-dollar securities over all periods. What I really would urge you to focus on is under fixed income, the line that says BC Universal. And why is that important? It's important because if this was just a retrospective, if it was just looking backwards, I would urge you just to file it. All right? That's all it's good for. It's history, it's over. The question is, what information about the future does this provide you? And what you see on that line is over 20 years, the BC Universal had a return of 5.5%. And over every single period that's shorter, that number goes down. And why is that important? Because the future return of the asset class is going to be driven by the yield of the portfolio. And 20 years ago, the yield was over 5%. Well, the yield today on that portfolio is a little over 2%. And that's what you should expect, maximum, over the next lengthy period of time. Why do I underscore that? Because it's going to be a challenge for you to generate the kinds of return that you've gotten historically. The other thing that's I'm sorry, is there a question?
Just a question. How much of that is because inflation dropped over that 20-year period of time?
To the extent that inflation and interest rates are highly correlated, you've had a period of 30 years where inflation has continually gone down and interest rates have followed suit. In the near term, even long term, I don't have any idea where rates will go. But I think most people who comment on it say that at some point in the future, interest rates will increase and that the policymakers will address concerns about inflation by slowly increasing interest rates, which will have a negative impact on the return of the fixed income portfolio.
So if inflation rises, that will hurt our fixed income returns.
It will. And the big hit question is whether that inflation is expected or unexpected. And if it's unexpected, then you could have a negative impact in stocks and bonds. If it's within expectations, historically, that's been positive for equities. Historically, you don't know that that'll be the case going forward. The other thing and Michael will talk about this during real estate, is if you look at 20 years under real estate, the return of public and private real estate is very similar. But over shorter periods, it's very, very different. And in fact, over shorter periods, the public real estate benchmark has significantly outperformed private real estate. Those things tend to change over time. If you go to page INV 130, there's a table that talks about just dollars. And in fact, that you had fewer dollars at the end of the period than the beginning of the period. The largest factor in that was not the capital markets. One of the biggest challenges you have as a big institutional investor is negative cash flow. And why is that important? It means you don't really get to reinvest new capital when the market goes south. And you don't have the ability to compound as you did 15 or 20 years ago when you had large negative cash flow and could really take advantage of dips. And that's why short-term volatility is so important, and that's in fact why, turning into the future, you adopted the RMS, is to try to change the shape of that curve. Almost done. INV 132 shows the returns of the various components of the portfolio. What do I take away from this? Well, first of all, over 10 years, the total portfolio had a return of 6%, so it trailed your interest rate assumption on an annual basis by 150 basis points. Now, so if you take 1.015 to the 10th power, that's how much behind where you were supposed to be. That's going to be hard to catch up on in an environment where equities are fully priced and interest rates are extraordinarily low. Why do I say that? Once again, this is to help you look at the future and have reasonable expectations of what to expect. What is the one takeaway?
No, I'm sorry. I'll wait till his.
Okay.
The one big takeaway on this one is you did a lot better than your peers. In large part, you did a lot better than your peers because private markets paid very handsomely over this period. Both your real estate and private equity significantly outperformed the public markets. A lot of that in real estate happened post-global recession. I would just encourage you to keep in mind that those huge gains that happened in real estate in the last 5 years will be impossible to replicate. That one should expect much more traditional rates of return from an asset class where most of the return should come from income as opposed to capital appreciation, which was not the case in the previous 5 years. And there's a question, Mr. Rosenstiel?
Yeah, I just thought the comment you made previously about how we have less free cash flow to reinvest is a really important issue. And I don't know if Ed Derman is here now. I guess he's in client advisory, but he provided me with some information, which I don't know if it was shared with the full board, but I asked to see cash flows so that we could see on an annual basis, as part of what went into the actuarial study, what's coming in and what's going out. And if you look at that, it's pretty interesting because there is a very large negative, and it continues even at the point where we've gotten up to the full new contribution levels, because the benefits that we're paying, because we're a maturing system, are quite substantial. They're in excess of $1 billion a month now. So I think it really does tell us something about our investment strategy and the need for liquidity, because ultimately we need long-term returns, but we also need the liquidity to pay benefits. I would just maybe urge that be distributed to you did get it. Okay, good. Okay, I'm sorry. I think the email that I got wasn't the one that went to the full board, so I didn't see that. But I do think it's very instructive about our investment. I mean, it shortens basically the term of our investment. So even though we want to be long-term investors, it forces us to be not quite as long-term as we would like to be.
And just to close, Madam Chair, why it's important on a going forward basis, negative cash flow, if it's not addressed very thoughtfully, could put you in a position where you need to sell long-term assets to meet short-term liabilities, which what happened to the S&Ls in the early 90s. And that's a completely losing strategy for an institutional investor. And so it's very, very important to recognize you need liquidity and you need to worry about downside risk. And that's why the creation of the RMS and the staff's implementation is so important, because it is during those short periods of extreme negative return that literally the future of the pension plan could be at risk. And that's why it's important to mention in the context of a performance report. Thank you very much. Happy to answer any other questions.
I do have a question from Joy.
Thank you. So Alan, back on, it was INV 128, you pointed out, you had us look at the 20-year performance of the S&P 500. And then I think what I heard you say was you pointed out that it outperformed the all-country world. And I guess I just wondered if you could help me sort of look at those statistics compared to the decision we just made with our asset allocation to reweight, to more non-U.S. and just what do we anticipate going forward that's different than what we're seeing historically?
Thank you. one of the key concepts in our business is called reversion to the mean, and that is that you're going to get an average over time, and there'll be highs and lows. And there's also a belief that there's no fundamental reason why the foreign market should perform better than the domestic markets over very long periods. We've gone through a period where the domestic market, for a combination of both the capital markets but also currencies, U.S. investments have done much better than foreign investors. We believe that, in fact, will reverse, and in fact, that's reflected in the capital market assumptions that went into the asset allocation. And so slowly going back into those foreign markets to that equal weight, we believe over time will accrue to the benefit of the plan. And that's a classic example, once again, looking at the report, of looking forward and not looking backward.
Okay, thank you.
Any other questions from committee members? Great, thank you, Alan. Appreciate it. All right, Jack, Client Advisory, I saw some members come in. Are we good to go? Client Advisory members are back in the room. I saw a bunch of folks, but I didn't see any, I didn't see any of the CPA folks, but. Okay, let's, I texted you, Jack, but you did not text me back to confirm or not. Check your phone. All right, let's go to, actually, the next one is real estate. Michaelin, our real estate semi-annual report. Hi, Michaelin.
It's better for the video.
Yeah. Love that.
Good morning. I'm going to ask you to start in your presentations on.
Turn on your mic.
Okay. I'm going to skip through this because I know we're going to be losing some people. So I'm going to focus on what I believe to be the more important areas of the report that you have in your books. We've changed the format, and what I want to walk the board through first is really compliance with the strategic plan. So the first slide is from INV 126, and it takes a portion that I've just tried to blow things up each section up.
Number, IMD what?
216.
Okay, so it's like,
I'm going back to these numbers.
216, okay.
This shows the risk composition of your portfolio relative to your strategic plan. You will see that within all of the categories, core, non-core, public, high return and value, you are within compliance except for in your high return, which is 31.7%. We've talked about this before. Over 50% of that 32% is in non-controlled, closed-end funds that are prior, vintage years prior to the market correction, and they're just taking their time in liquidating. We will be talking in closed session about actions your staff is taking and strategies for getting those liquidations to occur more quickly. But it's really just a position we have to hold until the managers begin to liquidate. The good news is that the other 50% is in post-market correction or post-market global financial crisis, and that portion of that portfolio is doing very well and being accretive to your total return. With your property diversification, this is, it's in red, underweight, overweight. These are less concerning. First of all, the region for other is international, and that's usually what causes the overweighting, and we're not concerned about that. Your underweight to office is actually probably a very good defensive position in the current market cycle, so also no concerns there. But we are working with your staff, and again, in closed session, I'll go through some detail on the strategies that are being implemented to position the portfolio defensively for what we believe to be a pending market correction. Leverage is in compliance, which is a huge feat for this fund and how leveraged it was when we started to work with you. Your leverage, I actually, in talking with staff, found myself saying, well, you could actually add more leverage there, and then took it back. But they've really done a very good job of reducing that exposure. And in this market cycle where we are today, and again, some level of an adjustment to be expected, that limited leverage will make you outperform your peers who have not reduced their leverage. So that's a very good sign. You will still have volatility, but you won't have the same level you would have had if that hadn't been reduced. With respect to performance, I'm going to begin being very deliberate in my delineation between total portfolio and then the total portfolio without legacy assets. This is because we've looked at removing the legacy assets, and there's, again, a strategy we'll discuss in closed session on what to do with that portion of the portfolio. You can see here that the total portfolio at 12.1% is underperforming the Odyssey plus 70 basis points, or Odyssey, which is 13.1, and the 10-year return, 3.3. That's where the legacy assets of investments prior to 08 have a significant impact on your total return. Ooh, my circles are off. This is the performance excluding that legacy, and really the intention here is to show the significant impact of that portfolio. If you look specifically at the core investments, 14.5 return for the 3-year is compared to the 12.6 when you include the legacy assets. The value at 24.4 is compared to an 18. And the high return of 13.2 is compared to an 8.9 with the legacies included. So the perspective here is really to show that the change in risk that the board initiated in 2008, as well as the staff's actions since then, have both increased returns as well as improved the go-forward portfolio and provided returns that are consistent with expectations as well. Then obviously 15.5 for the total portfolio compared to the Odyssey of 13.1 is an outstanding performance. I know this isn't the return you actually achieve, but I think the board should be very aware of the benefits of your changing the risk profile and what that's done for you. Alan spoke earlier about the fact that these are hugely driven by appreciation, and so I'm going to go to one slide in the market overview, this one right here, and just call your attention quickly to within the real estate returns section, short-term total returns. If we have modest economic growth, our expectation for short-term total returns for core real estate is 7 to 8%. That's half of what you've been achieving over the last 3 years in core. If we have an economic slowdown, and that's not much of a slowdown if you look at the other economic statistics, we're looking at 1 to 3%. So it is going to be significantly different going forward. Your more conservative position should hold you in good stead through the correction. And again, we'll talk about strategy for taking advantage of any current market cycle and correction in the market cycle when we have our closed session item. And that's all I'm going to hit for today.
Any questions from committee members on real estate? I don't see anything. That's it. Thanks, Michaelin. Appreciate that. Okay. I think we'll go back, Chris. Thanks for following us through this. We're going to head back on the agenda to item 7, like plan advisory. We've got our folks back in the room. So we'll go back to the top of the open session agenda to item 7. Chris, your CIO report.
Thanks. I was able to update. The slides are more current than what was in your book, so particularly for the teachers in the back. These are March 31 numbers in the slides, and the slides are available online, very bottom of the agenda. You can click on them and see them right there. So at March 31, as we had discussed, March was a complete reversal from where we were in February, and the portfolio bounced back up to $185 billion. We're basically break-even, flat return on the fiscal year to date. So a nice, strong comeback from what's been a choppy market. Here's the asset allocation. We continue to be very close to the ranges. If you look at the chart on the right, you can see the little dots are almost right on top of your targets, with the exception, as we've discussed, about private equity being below the range and below our estimated target. That has to do with our pacing. Staff is actively looking at that, but since that is a very long-term investment that takes 4 to 5 years to invest in, it is difficult to increase that allocation immediately. You can see the slight overweight to real estate and the slight overweight into global equity that make up for that underweight in the portfolio. But that is something we continue. We do talk to the board every month about and continue to monitor very closely. This is a graph of the Russell 3000 so far this year. So if you think about it, so I guess a horse race is a sports analogy too. I got to stop these, but we're 3/4 of the way. We're at the 3/4 pole through the year. So we're at March 31. 3 months left in the fiscal year, 90 days, fewer than that in trading days. And I have to say right now we're pretty much at break even. So 7.5 is not impossible, but incredibly highly unlikely to see suddenly the world get so strong that quickly. But you can see the volatility that we've discussed, that we've been experiencing in these markets, the immense comeback off the low in February, much sharper than I think people realized. Non-U.S. markets are still much more choppy and have proven more difficult. Even just in the last 2 days that you've been meeting, the market's been up 100, down 200. I didn't check the last couple of hours, but it was up 100 this morning. So volatility is just present, and we'll have to ride that out. I think, as Alan had said in his presentation, the longer-term assets of real estate private equity are what we're going to have to count on to give us some better income and returns so far in this fiscal year.
Chris, do you have just a thought of the attribution to why, even just in the last couple of days? Because I've seen that too. And is it just all the stuff you talk about in your report, like the political issues going around in the world, or why is there so much volatility in the last couple of days?
Well, and I think it's twofold. One, we think of volatility when we hear the number 100, that the Dow was up 100 or down 100, but you also have to realize that's usually 0.1%, not even a 1% move. So the numbers, it's the scale, the problem with the scale of the numbers. I think a lot of it is the uncertainty. There's no momentum in the market. As if I used to show you in this slide a picture, if we back up and look at the market over 3 years, we would see this tremendous run up in the market from 2009 to now. And we really are in this plateau where corporate earnings aren't very strong, the economy isn't very strong, but it's also not very weak. And I'll get to that on my last slide of kind of the pluses and the minuses. The economy is about 1% growth. You saw the unemployment statistics. I sent you the details on those just last month. They were okay, but not great. And so when things are in that, it's hard to have strong conviction, and I think partly the market is reacting to every news they get. If you remember in the fall, I said it was China, oil, and the banks, and it is continuing to be oil. So the first day that you were here, it had to do with oil, the move in oil prices, which really is just a global commodity and supply and demand and just as volatile. And then yesterday, the move down is partly on oil prices and then also in news on corporate earnings. So we're going to hit a rough patch because we're going to be coming into earnings announcements. And I think we're going to hear more companies report disappointment in their earnings, and their forward guidance is going to be weaker, and that's going to cause the market to be a little more gun shy. But we said at the start of this year, at the start of this fiscal year, we were very concerned that the rhetoric of the political election would really make the country and potentially the market just more skittish. And we're seeing that retail sales are okay, but not strong. The pounding every night of, things are terrible, but if you elect me, they'll get better, I think wears on people. And California will feel that. I've traveled to a few states where suddenly I realize, I'm in a primary state, because I would say that the TV ads really motivate you to turn off your TV. We're going to have to deal with that.
Books in June in California.
Yeah, it's going to be coming our way, and I don't know if we're going to enjoy it, but we'll see.
Chris, I've got
I
Harry.
can wait for Mr. Elman to finish his report, and then I just
The
have a
whole
question.
report? Okay.
Yeah, we'll just go through it.
Okay.
Okay, thanks. This is a slide that's in the risk packet that Josh Sheedish puts together for me, but it also, so it's INV 22. But I also wanted to put it up on the board to draw everybody's attention. We get that question periodically of how much do we have in China? We're worried about China. China still isn't even 1% of our portfolio. It is, even though it has grown to the number 2 economy in the world, it is very underrepresented in our portfolio because it's a communist country and there's not a lot of, it's still an emerging market. But, you know, so 75% of the portfolio is basically in the USA. And then when you look around the rest of the world, I always say, you know, it's really Japan and the UK, number 1 and number 2 behind the USA in our portfolio. But then it really does drop off dramatically. You know, 1.5% in Canada, 1.5% in Germany, France, Switzerland. So very small exposures. The portfolio is incredibly diverse, but yet I just always want to point out we have a home country bias. Alan pointed out that has served us very well. But I think it's important to point when people are worried about, you know, are you in this region or that region? We probably are, but at very small numbers. So we'll update this periodically just to help you, and you can keep it handy of, you know, when you want to know where are we located and what are we doing. I've talked to you a couple times about GDP. This is the most recent quarter, a lot less bright dark green, forest green on the map, because what we cared about was forest green. That means economies are growing strongly. And there's a good example. USA is a green and is growing, but not very much. My highlight on there is on China. China, while it is still green, the IMF forecast really has taken it down to where it's barely growing. One of our economists, cornerstone macro economists, Nancy Lazar, made the point to Michelle and Deb and June and I in December or in March that in their view, China is in a recession. You'll probably never see economic statistics from the government that say they're in a recession, but they really feel, based looking at consumer demand, house prices, a bunch of underlying statistics, China is literally shrinking as an economy. That's a far cry from the 5 to 8 to 9% growth we were getting out of China. So that is going to have an impact on the rest of those emerging markets, hence, you know, more magenta and red colors everywhere else in the world. And then here's one last thing I wanted to highlight, particularly for the CTA members who are not here. So, no. But for the members in the back. Within our enhanced index portfolio, we have been saying for a long time we wanted to be able to do a series of enhanced indexes, gender-based, sustainability-based, potentially, obviously the subcommittee is looking at carbon reserves and emissions-based, and even different strategies around corporate governance. State Street, to their credit, heard us talk about it, looked at the different indices, and we have not been happy with the gender-based indices that are out there already. They came up with a new idea and presented it to us, and we thought it made a lot of sense. And I'm pleased to say that when they said, well, we're not quite sure what to name it, it was June Kim who said, well, is the stock symbol SHE still available? They looked and said, yeah, it is. So they decided to name it. So it is an exchange-traded fund. We don't buy those often, but we do buy them periodically. Our interest is primarily in the index, which does not have as cool of a name. The index name is the Gender Diversity Index, but a lot of people refer to it as the SHE Index. Because we inspired them, they invited us to the bell ringing at the close. And I think if you guys can hit play on this, I can't. But if you would let us watch just a little bit. This is a video, and I'm not sure you have the sound up. So this is a video from the New York Stock Exchange. They provided, oh, there you go. You will see when we start clapping, you will see June Kim press the bell for the... You want to demonstrate again? How was that? Boom. I know, you have to wait a while. There we go. So 30 seconds before the stock exchange closes, they start ringing this incredibly loud bell that's right behind my bald head. And then at the 4 o'clock at the close, they strike a gavel 3 times. So here goes June. So that's kind of a once-in-a-lifetime opportunity for all of us to be up on that podium and then be able to ring the closing bell. There's the gavel. Boom, boom, boom. I did a C.
I know.
Sharon asked me what's it for. It's not for Chris. The C was for Cal Sturz. So, and then
Who are the other
hugs, and then
up there?
my favorite is the high five. There you go. Boom. And I think a big hug from Michelle. So, the purple, I have learned is a purple pashmina. I didn't get a purple pashmina.
Here, you can have mine. I have
There
one.
you go. I don't have, yes, I do not have pashminas. The products that they sell have a color code, and so they're marketing people. I had to buy a green tie, $49 for my green tie, and it was green and purple. So, yes,
It's
sir.
green. It's New York. It's the Jets.
Oh my gosh.
I'll make
You're
it.
out of order.
when
You're
will
out of
you learn?
order.
I love my green tie. I can wear it on Jet games. I can wear it to church on Sunday when the Jets are playing.
That's the right answer.
I believe the Jets open against the 49ers this year. Didn't you tell me that? I'd love to go. Yeah, there you go. So anyway, it was quite a thrill. We want to make it clear we are not endorsing their product. The intent here is the index. So you're aware, they will talk about the fact that we helped inspire it, but we were very clear with legal's help to not be listed as part of a endorsement or any support of their product. The companies in the index are comprised of firms that have 30% or more women in senior management, and either have a woman CEO or have 2 women on the board. It is rebalanced for the industries, because you can imagine, like the tech industry, there are certain industries that are very lacking in diversity, but we wanted to have a lower tracking error. So we put a little money in this. We'll watch it. We'll see how it does. We intend to eventually bring this in-house and just run it ourselves. And we'll see where the subcommittee goes in terms of its recommendation, and we're going to continue to pursue a corporate governance index. We've been talking to several firms about that. An equally weighted index. Now that June has built out her staff, we'll be able to run more of these enhanced indexes internally at a much lower cost. So thank you for letting us indulge us with that. That was quite a career moment for, I think, for Sturz and for us. So the risks in the portfolio, the black swans, I've highlighted the ones in red that we think are very present. I guess I would take, Andre Merkel is in better position than she was, but she was facing some election questions. Brexit is the one you're going to hear the most from me and everybody about. Some of the polls on Britain are still about 50-50. They think that the poll is, that people will express their views through a poll, but then when they get into the booth, they'll really think to heart. So this is a question of where the entire Great Britain, not just England, but Great Britain will vote to leave the euro. They are not in the currency, so that's the important thing for people. They have the pound, but they have numerous trade agreements with Europe. I think I've heard a number of close to over 50 trade agreements that they would be leaving and have to then renegotiate with just continental Europe. So the vote is at the end of June. I will keep you apprised. I think you'll see more pressure out of the UK market and certainly more angst in Wall Street. I can't emphasize enough, U.S. companies are very diverse. So again, Coca-Cola, IBM, just to name a 2, 50% of their earnings are outside the United States. I can't even imagine Apple's earnings are, all over the globe, but these companies are all interconnected, and if Britain chose to make that kind of a move, it would have dramatic effects. I can't tell you that it would be always negative, and we'll send you information as people sort of handicap and they take positions on what are the potential ramifications of leaving or not. If they choose to leave, then there's the whole issue of what happens with the Irish again and their vote. So it's just really going to be difficult. And then obviously to us, the U.S. presidential elections certainly have been chaotic on the market. And as I said to my wife, I think this will be the first time that people in America want to watch a convention, because I think generally people have tended to avoid those other than the very strong political people. So we'll see. The positives are getting pretty few. Obviously, historically low interest rates, GDP is positive, but not by much. So in a nutshell, Sharon, long-winded answer, this is the reason the market is so volatile. There are positives, they're important, but they're not many. And there's all these black swans on the other side that just scare everybody out. So it's like everybody's jitterish, and they want to sell when they can, but then they want to buy because they need to be exposed to stocks. So it's just a really tough marketplace.
Any comments from you guys before? I have a couple folks in the queue for questions. So maybe I'll take you guys first, and then we can hear from Alan or Stephen if you have any other commentary. Harry?
Thanks, Madam Chair. So I have a question for our consultants, and that's around prolonged, if we're in a period of prolonged low energy prices, and if there's actually a shift that's taking place that is dramatic. There's been a lot written about that. Do you see that as a net? Do your firms have an opinion on whether or not that would be a net positive or a net negative for global GDP?
And can I dive in before you guys, while you give you time to think about that? Tom Unterman had asked a question similar to that, Harry, at the last meeting. So Josh and the team on INV 25, they produced a report to show particularly the sector weightings in the S&P 500. The particular interest was the black one at the top, which is energy. And you can see how energy has ebbed and flowed, but now here we are, because of the low prices, is a much smaller sector within the S&P 500. And you can see the tremendous growth of technology, how that's a much more important part of the markets. So there's just sort of the backdrop of how energy has grown and shrunk over time.
The short answer, Harry, is low oil prices and low energy prices unequivocally are favorable to higher wealth generation and GDP growth over long periods of time. However, the transition from a high oil price regime to a low oil price regime is very disruptive to business models and to individual countries. And that disruption in the short term is what drives markets. So it's not any surprise that when the U.S. stock market was down 10 to 12% this year through mid-February, oil prices had been down 25% or so. When oil prices rebounded back up the last 7 weeks, the stock market rebounded back up with them. Investors are concerned about non-performing loans on bank balance sheets. They're concerned about energy companies and a wave of defaults around that. Longer term, lower oil prices and lower energy prices are unequivocally positive.
Any other thoughts, Alan?
I'll be quite brief. I don't have a clue. I don't think anyone really knows what the future will demand. The only thing that I do know is that the global demand for energy will increase by anyone's economic forecast. So the demand for energy in various forms isn't going to go away, and it's not going to be reduced. It will increase, particularly in the third world.
Thanks, Alan.
And historically, very importantly, lower oil prices have been good for countries that are energy importers and not good for energy exporters. And our economy we are pretty much in the middle of that right now. And so, in theory, there should not be a huge impact upon the domestic economy.
And I have one question about, Mr. Allen, you had a slide up there about the top 10 country exposures. So those numbers represent the percentage, like 75% represents what, 75% of the portfolio?
Total portfolio, 75% of 185 billion.
All right, so that's what I thought it was. It would be interesting at least I think it would be interesting if it was possible to do it, would be to look at where revenues are coming from. In other words, so 75% of the portfolio has U.S. exposure, but for example, in equities, where are the revenues for those countries? So it's maybe a U.S.-based company, but through globalization, where are the revenues actually being generated from? It's not something that we need tomorrow.
No, yeah, sorry, Harry. I was just trying to find my staff. They say we have a product that can do that now, so we will.
So could we put that as an information request for maybe for next, when appropriate? It's not something that we need right away.
You got that one, Lon?
Thank you, Madam Chair.
Well, if
Your
it's
Honor?
all right with you, we'll include it in the next CIO report in the
Say, can we have a-
June agenda.
June,
Great,
if it's,
thank you.
if it works. Okay, great. Thanks, Mr. Keeley. Betty?
Thank you, Madam Chair. Really appreciate the update on the whole issue of oil pricing, and I guess we're going to see a lot of activity with respect to that sector. But the bankruptcies that we're seeing now, is that mostly just to restructure debt, or are they really to getting out more deeply?
Yeah, so in the United States, there was a massive buildup in infrastructure to extract oil and gas over the last 5 or 6 years, and that infrastructure was largely built with business models that included a certain amount of debt that, for the last year and a half or so, could be repaid through oil that was being extracted from the ground, the price of which had been hedged at prior high levels. Those hedges are running off. Fewer and fewer oil wells are operating because of the current low price of oil, and so the ability for these businesses to continue to service their debt is diminishing. So the cost at which these business models survive differ quite considerably depending on where they're extracting oil. But at $30 a barrel, there's not many E&P outfits that could survive for long. So that's a big risk. A lot of that debt is held in the high yield bond market. So you've seen credit spreads widen out in the high yield bond market up until recently, and a lot of the debt is held on bank balance sheets as well, which has caused bank stocks to plummet in the first 6 or 8 weeks of this quarter. Anyway.
So I guess there's kind of a lot of stuff swirling in my head around just oil generally.
Sure.
And
Yeah.
I guess apropos of our conversation in Governance Committee yesterday about kind of how consultants can be helpful going forward.
Sure.
Yeah, I'm looking at how what's going on with oil is going to affect our fossil fuel investments, how it's going to impact certainly how we're going to do our ongoing investigations, and also just engagement with oil companies on climate risk disclosure. And so I'm just wanting to see if we can just have, I guess, a little bit more regular touch with this issue, so that as we deal with those other aspects of it, we can kind of connect the dots a little bit better.
Sure.
If that makes sense.
Yeah, happy to do it. The one thing I want to emphasize, which Alan sort of alluded to in his comments as well, is I not speaking for Alan, but I'm guessing neither of us believe that we're destined for a low oil environment for a prolonged period of time. I think the story of oil is one of great volatility, not one of shifting price regimes. And so when you're looking at those types of issues, you want to look at on a forward-looking basis how a increase in the price of oil will affect those issues as well, not just a maintenance of current low levels.
Yeah, I think to the controller's point, though, I think that's something, obviously we have a lot of engagement around, there's a lot of engagement with a lot of institutional investors around fossil fuels, and then obviously just oil in general, and energy is just a huge topic, and it's a huge piece of our portfolio. And so I think it would probably be helpful for us to kind of continue to sort of raise the conversation, because we're going to continue to have questions around how we're looking at our portfolio in fossil fuels, obviously, and then also as we try and think more about what opportunities there might be in clean energy and other options for energy in the future, the risks and rewards there. So I think we need to kind of keep that in the forefront. So I appreciate you raising that, and we'll make sure the consultants have that be risen when we have these conversations with the investment committee.
And then one other thing, I just wanted to thank and congratulate the staff on the Gender Diversity Index. I think this is really a nice kind of marker to have. And I guess a question, have we seen much interest in terms of other investors just in the short period of time?
I have not tracked it that closely. Not yet. So the assets under management haven't grown that much? Not yet. Unfortunately, not yet.
Okay.
Can can I ask a piggyback question on Controller Yi's comment? Because I know 10 years ago, or when I started getting involved in CalSTRS and my relationship with CalSTRS, that those kinds of indexes or specialized funds were sort of looked at as, isn't that cute that the women want to have a fund or but it seems like the more conferences I go to now, especially in the last 5 years, there's been a lot more traction and more kind of, I think, gravitas given to the idea of, and so I just wondered if you're seeing that as well, that you feel like, I think in the past the issue was, oh, these aren't making money. I mean, they make people feel good, but fiscally they're not really moving the needle. But from what I hear from folks I talk to, it seems like there is more kind of movement in terms of the kinds of money that these funds can make. And so
There's absolutely an increase in a number of different ways. You'll hear the term impact investing, mission-based investing, and then obviously ESG factors and based investing. I hear it most loudly probably with mission-based investing in the endowment area, where it is family money, and so there's more of a direct interaction with the owner, and we're seeing them start to change their investment philosophy to be more in line with the mission of the endowment. And so I think you'll still hear it there. Obviously, college campuses are pretty vocal on many of these issues. And then I think Jack and I would agree the international community is more attuned to having discussions about this. And just like our investment beliefs exercise, trying to figure out how to align and better attune. I always say to people, we're always only about maximizing our rate of return, but we want, we struggle with active management, and if there are ways we can tilt the portfolio that potentially could add value or reduce our risk, we should look at these. And it is, as we say, the material non-financial information. And I think there's more discussion about what's in the footnotes and financial statements and what are companies telling us about their business operation, not just the hardcore accounting numbers. So I think, obviously I agree, Sharon, and we're certainly active and involved in a lot of those events, and we're going to continue to probably see this grow over time. I keep being told by the people that focus in retail investing, the Merrill Lynch's and the Charles Schwab's, that the millennial generation seems to care much more about these issues than the baby boom or Generation X or the traditionalists did. So we'll see if they stay through it. Obviously, millennials don't have a lot of money yet, but we certainly see it in the investment staff. There's much more interest in a younger investment officer, not just I want to make money, but I want to know how it's being made. And so I think we're seeing the interest in this area continue to grow.
great. Are you all set, Chris? That's all right. Let's go ahead and go to item 8, which is the approval of our minutes from the February 3rd open session. Entertain a motion to approve.
So moved.
Is it seconded? Okay, it's been moved and seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? Great, thank you. You guys looking at me? Is there something wrong? Okay, all right. We're looking at item 9, investment policy and management plan revision. Chris, second
Back to
reading.
me. I always say
Second
too many
reading.
agenda items with my name on it. I got to fix that. So this is back for your second reading. And I would highlight on INV 35, items 1, 2, and 3 were issues you resolved at the February meeting or the November meeting. So those are consistent. But I did add 2 new things. So you can consider this a first reading and push it off a final reading in June if you want. But we did put item 5, we did put the potential plan on how we would implement this new asset allocation. As we have discussed, this is a major shift in assets, and we think to do it prudently and efficiently, we should really take 2 to 3 years. And then we also added item 4. This is an item that publicly we haven't talked about much, but has been talked about with the board from my personal chief investment officer evaluation, was the idea of bringing back the idea of a reference portfolio. As we discussed during Alan's presentation, the benchmark, which we use internally, is still a very valuable tool, and we'll still use it and produce it. But it is the concept the Canadians created of creating a portfolio that the public could also invest their own 401k or 403b money. We have selected a Morningstar index that is used to measure target date funds. You're probably familiar with those in a 401k. We offer them in the Voya product. I always say that as a pension plan, we have a 30-plus year horizon. I think the actuaries would say it's even more than 30. So my analogy to people all the time is we're kind of like a 35 to a 40-year-old teacher. We have at least a 30-year investment horizon out in front of us. We need to be moderately aggressive in that asset allocation. And so we're using a benchmark here that's basically designed for moderately aggressive target date funds that are out there right now at 2045 or 2050. We did look, should we just use a target date fund? Well, the problem is that'll roll every 5 years because the difference between us and a human being's finite period has a birth date. We are in perpetuity, hopefully, so we constantly are extending out that 30-year period. I'd encourage you to turn to, let me flip over the page here without knocking over the microphone. INV 55 is the implementation plan that we're proposing. I think it's just so because we're in the middle of a fiscal year, we really felt we would keep the current fiscal year targets in place. Then at July 1st, we would then shift to that new asset mix. We're not changing assets. That column that's labeled 2016-17 is basically the asset allocation we're at right now. So if I gave you a word picture, we're shooting for an efficient frontier. We have a dot on that frontier. We're right here now. So instead of trying to aim to where we wanted to be and then go to where we want to be, we're going to plot from where we are now and what's the shortest distance to get to where we want to be. I also want to really highlight, if you notice it says step 1, 2, and 3. It does not say years. It does not have a date. We learned all the way back in 2003 that by putting dates, then we're chasing a calendar and not being investors. And so the intent here is we've established steps, kind of dots on our map of how we get there, but we'll do it based on what the markets present as an opportunity. So it may be that we're able to get there quicker because the opportunities present themselves, but if, as we've said, if prices are high, we're not going to chase high prices. So we will come back to you every 6 months and say, is it time to move to step 1 or step 2 or not, and present that to you. And it may well be that we end up creating a step 2.5 because maybe we'll be implementing RMS and global equity fine, but we'll find out again that there's no inflation, and so we shouldn't be chasing inflation-sensitive assets. But that's a real important addition. We had a snapshot of this, but this is the formal plan to implement RMS, implement truly global equity, and then obviously continue to implement the inflation-sensitive asset classes. And then item 4 that I proposed is back a couple of pages. If you look at INV, there it is, INV 47. That's where we talk about, we still have our policy benchmark, and then adding in the idea of a reference portfolio for public use, just to give them another benchmark. So we would still continue to publish 2. You'd see it, but this would allow communications to use another thing in the press releases and things like that. And again, it's the idea of an investable benchmark that our members would gauge their retirement investments against. Open to questions.
Thanks for the report and breaking this down for us, Chris. I'm comfortable with us taking action on this today, if it's the desire of the committee. I would raise this one issue. It's on INV 37, just to bring to the attention of my colleagues, I think is something worthy of noting, is the implementation plan, the first 2 sentences under the implementation plan. The shift of, and it talks about the dollar amount that's being shifted over the next 3 years, And then the second sentence says, this is one of the largest shifts CalSTRS has made since the addition of private equity and real estate since the 1980s. So I would just ask that we be thoughtful about how we monitor this as a board, and perhaps we need to look at something off-cycle. We don't have to make that decision today, but those two sentences, I think, are very strong statements about the magnitude of this change that we're taking place and our role as trusting but verifying an oversight responsibility may require a little different structure for us to have that oversight over the next couple of years.
Yeah, and I would just, and I know Mr. Unterman might want to comment on this too, but we've discussed about making sure RMS monitoring is part of our work plan for next year, and I think it's worth a conversation when we get to the work plan to talk about ideas of structure. Do we want that as a deeper dive in the investment committee? Do we want that off cycle somehow? So I agree with Mr. Achilles' comments that it's an important decision and we need to make sure we're providing oversight.
And if Fiduciary Council has an opinion on that, they can give us an opinion at some point, not necessarily today, but in terms of the shift in our responsibility to oversee it.
Okay, thank you. Mr. Unterman.
Actually, we're all three on the same wavelength. We have two things that are really very big and significant: the equity reallocation, and then the RMS program and its implementation. And it may just be me, but it's very hard in a very busy board agenda to get the requisite focus, and so I would urge the staff to think of other ways: a study session, offline, or not in the board meeting set, not in the board setting, much like the special committee, the current committee we have, or something else, just to work through the mechanics of what's involved. I think would be helpful on both topics.
I would say with meeting face to face is always the best, but with technology today, there's got to be ways we can get you information and have discussions and do it under the state laws.
Right, and making sure that we have public, access, and we can have closed sessions,
Somebody-
open session.
I mean,
Podcasts, we'll create an app. There's got to be an app for that, right? RMS app.
the scary thing is that there might be an app to transfer all the assets.
Yeah, I don't want that app.
We don't want that. Yeah, we just have the cyber risk.
But, and I don't see any need, maybe you will, that those discussions or those studies be done in closed session. I mean, I think it's
I mean, the
perfectly fine
public's
to do it in an open way. It's just,
Absolutely.
I was impressed by how much we learned in the early sessions of this committee on special mandates about our index performance.
Paul.
Thank you. A couple of questions, Chris. On this reference portfolio. So I'm not sure I understood. The issue with a reference portfolio is it's a target date fund, right? So it's like target date fund 2050. So a 2050 target date fund would be 34 years from now. So would we, if we were to choose that, in 5 years, would we be changing it to a target date fund 2055, or would we always stay with 2050? I didn't understand
Yeah,
that.
no, that's why we looked at the idea of adopting a target date fund as the reference portfolio, but felt that didn't make sense because you're right. Because we're always a 30-year window. Every 5 years, every 2.5 years, we'd have to now shift to the new one. What we're recommending is actually an index designed by Morningstar to measure those types of target date funds that have roughly a 30-year horizon, very similar asset mix to us of 80-20, have a global equity involved. So it's designed, it's a tool for people that are in those kind of funds to be able to say, oh, how did my target date fund do versus a rough benchmark of target date funds.
Of target
so
date
this-
funds that have a target date of about 30 years out. And
Moderate,
and
the thing,
with moderate
it is a
risk.
moderately
Right.
aggressive
Right.
risk, and
Yeah.
it really, I tuned it to the asset allocation, so it would have that kind of constant, the asset mix would represent us, and we'll monitor that.
I think this is a fine idea. I think we have to be careful about how we represent it because for our members in the DB program, that isn't an option for how their money gets invested, right? I mean, their money gets invested by us, and we're in a different kind of environment in which we operate. So, as long as we don't suggest that it is in any way an option that our members have, because it's not an alternative to the DB plan. Our members are in the DB plan, and we think that's a good place for them to be because we think there's lots of advantages that we can bring to the investment. In addition to which, the members don't get the return of the fund. The members get a pension payment based on a formula, regardless of how well we do. I mean, if we earn 3% or if we earn 15%, that doesn't affect the formula that member gets. So I just think we need to be careful in terms of that. I also think that I would like to take out one sentence, and that's in INV 47 under the policy benchmark index. The last sentence says, therefore, this index, that is our policy index, not the reference portfolio, this index is intended primarily for internal use. I mean, it's very much for internal use, but it's also for external use, because it's really, I think, what makes us accountable for whether we're doing a good job in managing the DB programs and investments. In other words, how we compare to the policy, to the reference portfolio isn't the issue. That has no bearing on the success that we have at measuring, at investing our portfolio. What we've said is we're supposed to hit these policy benchmarks. We're supposed to hit 7.5% in aggregate, and we have benchmarks for each of the asset classes. And so while it's a very important tool that we use internally, it also seems to me that we shouldn't suggest that it's only for internal use. It's really the way we're held accountable externally as well. So, I'm happy to approve this today, but I would like that one sentence taken out because I think it's inconsistent with. So I don't know. I have another question, but
Okay.
but I don't. Maybe we can.
Steven?
I'll risk one comment. The one thing I wanted to highlight with respect to not whether the policy index is used internally or externally, but whether or not it's a measure of whether you're doing your job to ensure the investment program. That's true after you decide the asset allocation policy. The asset allocation policy is going to drive 90% or more of your returns over time. So to compare your returns to the current policy index really only measures the last 5 or 10% of whether or not the decisions you've made have worked or not. The real driver is going to be that asset allocation, which isn't captured by that policy index.
I agree. I agree. But, I mean, we have benchmarks for a reason because we use those benchmarks to measure how well we do relative to those benchmarks. And I'm not saying, I'm not suggesting. I just don't want to have in this policy to say that those are primarily for internal purposes because I think that sacrifices or compromises our public accountability. That's all I'm saying.
Any thoughts from I guess I'm not totally. The language says primarily for internal use, so to me, it doesn't exclude external use.
No,
so
it
I guess I don't. so at the pleasure of the investment committee, I don't know if there's other thoughts about this or how we want to handle it. Can I just pull Harry up in front if it's connected to this? You guys, I know we have a queue here, but oops, I just messed it up. Sorry. I don't know how to do this. Okay, everyone's gonna have to re-queue.
I'll
I'm
just
sorry.
use my teacher voice. I would just welcome the consultant's opinion as to whether or not the suggested amendment by Mr. Rosensteel changes the substance of the policy in any meaningful way. And if it doesn't, then let's adopt the amendment.
In my opinion, it doesn't impact anything.
Okay.
And does staff have any reservations relative to the proposed, it's essentially an amendment to it?
No, it was
Doesn't change
more
this.
intended for the internal audience to make sure we knew what we were doing.
Yeah, sure. So if it doesn't change the substance, Madam Chair, I'm
Sure.
certainly okay with it.
Okay. Steve?
One comment to make related to the reference benchmark. Like all benchmarks, there's points in time over short periods of time where you can expect to underperform and points of time where you're going to be outperforming. So I think it's useful to know the structure of the index relative to your portfolio, and therefore you can predict when those times are. So the two major distinctions are the reference benchmark that staff has put in here does not have any private assets, private equity or real estate. So all else being equal, when the public markets run and they're outperforming private assets, that reference benchmark is going to be very, very difficult to beat. Secondly, the reference benchmark has a home bias in it. So as you migrate away from a home bias, if U.S. equities outperform international equities, that benchmark will be more difficult to beat. And so like all benchmarks, I would just take it with a grain of salt, particularly over short periods of time. Your differences from the index are going to be driven much more by the structure of the index than by any sort of definition of skill or lack of skill from staff.
Okay. And I apologize, I popped everybody out of the queue. So Joy, Controller Yi, Paul, you said you had another question? So
different
okay.
topic.
Is it all right if I take
Sure.
Betty and
Yeah.
Joy? Do you want to chime back in, or I think you were in the queue, and I'm sorry. Okay. So Controller Yi.
Yeah, I guess this reference benchmark is giving me a little bit of pause in terms of how we're going to represent what it is, I guess. And so I guess the first question is, how are we planning to roll it out and publicize it and kind of talk about its purpose?
It would just be listed, in fact, in the semi-annual performance report, we created a one-page at a glance and listed that as a reference portfolio, just be part of the, I would envision the press releases on our performance would be, here's the CalSTRS return, here's the policy benchmark, here's the reference portfolio benchmark. So they would have two benchmarks to gauge our performance against. And Alan would include it in his semi-annual performance report.
I think that it's really going to be important that this is the kind of thing that's clearly explained, so someone who looks at it either sees a definition or a footnote that they understand how it's calculated and why. And I think that your question is really well on point, and that is it can't be a number that's just floating out there. It needs to be explained and what its intent and how it's created so that someone who looks at it can put it in context, and I think that's the staff's intent. And what probably makes the most sense is to come back with that sort of explanation that's then included in future documents.
I think that would be helpful, because I guess absent that, why wouldn't anyone just resort to looking at the S&P 500 for comparison, or how would it be different? So.
Well, and we did have a conversation when we were on our prep call, Paul and I, with the staff about sort of the function of this, and is it confusing to the public, or it seems like the communication around how this is to be used for a public purpose seems critical in order for it to be a helpful tool and not another
Hindrance, right.
confusing
I was just
element. So.
going to suggest, Betty, INV 107, just an example, not the official one, which is where we included it and put a reference mark, and as Alan said, we noted the reference portfolio is a Morningstar moderately aggressive target rate retirement fund composite. But we certainly would do that every time we you can, as I said, you can approve this, you can approve parts of it, or put it off for a second reading, whatever you'd like to do.